Can you all hear me okay?
Yes.
Fantastic. Okay. Sorry about my phone just going off there, my home phone. But yeah. Okay, so today is going to be the last Q&A session for the different units. And I will tell you later on what we're going to be doing next Friday. Next Friday is going to be pivotal, it's going to be very important. So those who are not here today, you need to let them know. At the same time, we'll post a message on Moodle just to make sure that everybody gets the information for next Friday. So today does mean that this is the end of any formal live Q&A session, which means that next week there isn't any requirement for your small group activity. So essentially next week is your revision week. Okay, so what do we have to look at today? Today we're looking at Unit 4. Specifically, we're looking at corporate governance. Part of the exercise that you were meant to do this week was to actually look at the different approaches to corporate governance and how then you can try and relate a specific approach to the corporate governance regime that is in any country of your choosing. Perhaps preferably your country of origin. What kinds of approaches does your country employ in order to develop the corporate governance strategy or regime? So I'm going to share my screen and just very briefly discuss or summarize, I must say, some of the aspects that you already have in your lecture notes. Now, remember that every information on this slide is already part of your Moodle book, but also to supplement the Moodle book or to make sure that if there's any information on this slide that is not specifically or explicitly stated in the Moodle book, this slide will be posted on Moodle by the end of today. As usual, if you have any question in between my discussion, then let me know. You can post that on the chat function, or you can just unmute yourself and ask a question. That is perfectly fine for me. Okay, so as I said, we will focus specifically on corporate governance. IFRS and the future is a really short section, but also is basically in relation to the International Financial Reporting Standards and the board that develops those standards and how it has actually evolved over time and the range of projects that they have in the future. So, how do we define corporate governance? And why is it important? You know, this is not something that I would normally waste time on because at this stage, the expectation is that even if you haven't studied corporate governance, you would have read about corporate governance or you would have heard about corporate governance. So it is a process, it is a means by which corporate affairs are directed, a means by which division of power is ensured, so that one person in the organization is not responsible for making all of the decisions or the key decisions, but also as a way of ensuring that those charged with the responsibility of taking decisions are accountable to the different parties, for example, to shareholders and so on. So that really is corporate governance. And this came about as a result of a range of issues, which we will look at in a minute. So what does it do? If corporate governance is a means of ensuring that the corporate affairs are directed as well as managed, as well as division of power within the organization, but also to ensure accountability, then what is it all about? What it does, it ensures appropriate control systems within the organization. So to say that there shouldn't be one individual responsible for making key decisions is to ensure that there is appropriate internal control systems within the organization. So one person doesn't sign all the checks. One person is not in charge of key decisions. One person is not in charge of remuneration. One person is not in charge of auditing and things like that. That way, corporate governance regimes argue, it actually does help in terms of accountability and in terms of the stewardship function of directors and managers. Okay, so one single individual should not be dominating the affairs of the organization. Okay, so corporate governance then in that context is concerned with the relationships between management, boards of directors, shareholders, other stakeholders, which we will look at under the different approaches. And most importantly, corporate governance is a way of ensuring that the corporation is actually run in the interests of the owners, which under specific regimes is predominantly shareholders. Under other regimes, it refers to a wide range of stakeholders. So in your lecture notes on Moodle book, one of the things that I mentioned is the different regimes that we actually have across the world. We have one regime that is Anglo-Saxon, which simply relates to the kind of regimes that we have in the UK, which is really focused on shareholder perspective. And that is the kind of system that we have in the UK, similar system in the US, Australia, mostly English-speaking world. But we also have another regime, which is mostly practiced in continental Europe. This is where stakeholders are much more important than shareholders. Okay, we'll look at different regimes in a minute. So transparency and accountability is also part of what corporate governance tries to ensure. So what are these approaches? Again, for finance students, this theory shouldn't be, you shouldn't be strangers to this theory. Agency theory is a really widely read and widely studied theory in finance. And so what I would normally do, not to necessarily dig into the theoretical underpinning of this particular concept, but to show how it relates to corporate governance. So agency theory has been the greatest influence on corporate governance. What does it do? It regards the corporation as a nexus of contracts between these different compartments. What it does then, agency theory, it looks at the divorce or the disjuncture between the ownership of the organization and the control of the organization. In other words, those who own the organization do not control the organization. What happens is control is delegated to those who run the corporation. So there's a problem. The problem then is agency theory refers to owners of the organization as the principals and those who control the organization as agents. So this is common knowledge, I suppose. Okay. So the agency problem then is the fact that agents may not necessarily make decisions in the best interest of the owners of the organization. In other words, once control is delegated to the agents then will try to satisfy their own self-interest in many ways, as opposed to working in the interest of the principal or the owners of the organization. So corporate governance then steps in to say, no, we need to align these interests because really the corporation is there to meet the needs of the owners, in theory at least. But also added to that, agents may award themselves perquisites. For example, when we talk about perquisites, we're talking about ways of rewarding managers, for example, bonuses. If there isn't any checks and balances to ensure that bonuses, for example, are not just awarded because managers feel they need to award themselves, or free holidays, for example, free jet rides, company cars, company accommodations, and things like that. These are all perquisites that managers could award themselves, irrespective of whether they're actually performing well in terms of returns for shareholders or in terms of increasing shareholder wealth. And so, therefore, uh, corporate governance regimes or systems steps in to say, well, we need to try and align these and to ensure that managers are not just awarding themselves millions of bonuses at the expense of the principal. So that's the agency problem. Corporate governance, as I said, steps in to try and minimize these agency problems. So on the one hand, the corporation is owned by the principal, the shareholders, but on the other hand, that control is delegated to the agents in order for them to run the organization, which does mean that the agents, which means the managers, the directors, and so on, these are the people who have sufficient knowledge of the running of the organization. The owners don't. So the directors and the managers have the means to award themselves, substantial amounts of perquisites. But corporate governance then is a way of monitoring that particular aspect of the running of the organization. Okay. So under corporate governance regimes, there is increased emphasis on the extent to which boards are effective and those boards are accountable, okay, to the shareholders. So shareholders do have some role to play, but it's really a minimal role when it comes to the running of the organization. So, in summary, agency theory has been the greatest influence on corporate governance, and I will show you later on why that is the case. But these agency problems are identified within the theory to say there is a disjuncture, there is a divorce between those who own the company and those who run the company. And when that happens, there is a mismatch in interests. Those who run the company don't own the company, but they might end up making decisions based on their own self-interest as opposed to the interest of the owners of the organization. And so corporate governance regime steps in to monitor that particular aspect and say, well, you have to be accountable to the specific owners. Stakeholder theory, on the other hand, doesn't just necessarily look at shareholders. It extends this to a range of stakeholders, including shareholders, employees, suppliers, customers, the local community, future generations, even animals. Okay, now this becomes really convoluted. It becomes much more complex when we start looking at, the specific detail of the kinds of stakeholders we're looking at. But the local community, so the corporation needs to be accountable to the local community. In other words, when it comes to pollution, when it comes to animal welfare and things like that, even future generations. So those babies that are yet to be born in 2050, they need to be taken care of before they are born. Interesting concept, but that is what stakeholder perspective brings to corporate governance. Okay, so under agency theory, shareholder wealth maximization is key because the theory posits that the corporation actually does exist for in order to make value for shareholders. Under stakeholder theory, shareholder value maximization is no longer the main priority. The key thing then is to link the responsibility of the organization to social responsibility. In other words, the corporation doesn't just have to think about maximizing shareholder wealth, but they also have to think about corporate social responsibility. How is the environment within which the corporation operates? How are the employees? Because these employees are connected to families within the local community. These families are connected to other social organizations within the community. And so therefore, stakeholder theory says all of these constituent stakeholders need to be taken care of and satisfied. Ethical reasons, perhaps. Financial reasons, well, there has been an argument in the literature that actually companies who engage in corporate social responsibility do increase their overall financial standing. So there are customers who would not invest, or there are investors who will not invest in companies that are deemed to be socially irresponsible. Okay, and of course, there are investors who will only invest in companies that are green, for example, or companies that do not go about polluting the local community or the local environment. Okay. So when it comes then to corporate reporting, it doesn't just have to produce the income statement, the statements of financial position, and so on, in order for shareholders to use them. It will also have to include other forms of reporting in order to meet other stakeholder needs. For example, part of your coursework, I think it was, you were meant to look at the corporate governance as well as the corporate social responsibility of your choosing company. So, on the stakeholder perspective, there has to be a report on corporate social responsibility. There has to be environmental reports, for example. There has to be data on employees. So, how many employees did you have last year? How many employees did you hire during the year? And what is the average salary, for example, that is paid to employees? And so on. So stakeholder theory is a much more varied one. Okay. And it does cover a wider range of stakeholders. Now, I will stop talking in a short minute. So then, the key question in relation to your small group activity for this week, which you should have already done, is which one of these theories, or indeed, is there a mixture of these perspectives in relation to the regime that you have in your chosen country, or specifically in your country of origin? I have given, and I will make that available by the end of today. I've given you an example of what operates in the UK, the kind of regime that we have in the UK. So we know that corporate governance regime really emerged in the UK in the 1980s. And this was basically in response to, as I said earlier, why did corporate governance become a global phenomenon? So in the UK, at least, there were high-profile corporate failures. These scandals, and of course, we know also in the US. So in your Moodle book, you will find a mention to the Sarbanes-Oxley Act in the US. All of these against the backdrop of high-profile corporate failures. What were some of the problems that were existing at the time? A range of financial reporting irregularities. So at the backdrop of the Sarbanes-Oxley Act in the US, for example, we know that Enron failed. You remember the dot-com bubble. In the UK, we had Robert Maxwell and other high-profile corporations failing, and so on. So there were a range of financial reporting irregularities. Businesses were failing, surprisingly. Auditors didn't really have substantial role in terms of investigating these companies. And there was a disjoint between directors' remuneration and company performance. So it really didn't matter if the company was making high profit, or what was important for directors was to award themselves huge pay and huge bonuses. So initially, the UK corporate governance regime, after a range of reports, which I will not go into just now, but the UK corporate governance regime was to actually tackle these issues. So what we then see in the UK is an outsider-dominated regime. In other words, as we have seen under agency theory, equity ownership or the ownership of the firm is dispersed among a range of shareholders. So these are outside investors, not the government, not the local council, but individual investors, a wide range of these, including institutional investors as well. So we can then argue that this regime is largely underpinned by agency theory. The reason for that is we have a shareholder dominated ownership structure in the UK. So corporate governance regime is to cater for the interests of these shareholders as a way of aligning those interests with the interests of the agents of the company, in other words, the managers of the company. So these large firms, of course, we know are run by directors who are the agents, but they are owned by the shareholders as well. So you can see how I'm trying to relate agency theory to the kind of regime that we have in the UK. And that's really what the small group activity was meant for you to do. So some of the agency problems that we explained earlier are evident in the UK. You know, agents behaving in their own interest as opposed to in the interest of the shareholders. So under the UK regime, investors then enjoy protection under company law, for example, but also corporate governance has a potential for shareholder democracy. What that means is the shareholders do have some form of control when it comes to electing or removing directors. At least they have a say during the annual general meeting in a way, as a way of giving them some form of control over the running of the organization. But also as a way to keep managers in check, the corporate governance regime in the UK does have within it, it doesn't state explicitly, but there are potential for hostile takeovers. So if you are the CEO of a company, you wouldn't want your company to be taken over by a competitor, for example. And so therefore that then serves as a way of disciplining management in order for them to align their interests with the interests of shareholders. Okay, so that's just the kind of exercise I was expecting from you for this week's small group activity. What are we going to do next before you start asking your questions, if you have any? What we're going to do next week is to have a revision session. As I said before we started, this is a really important session next week. Next week, you need to start then revising the material for your exam. We still do not have a final date for the exam, but hopefully by Friday next week, we will have an indication. But what we want to do next week is to have a revision session and a Q&A session next Friday around the same time. First, we'll want to talk about the structure of the exam. We'll want to talk about the different topics that are examinable. So the different areas, which particular units and which particular lessons under those units that are going to be examined or that are potentially examinable. And we'll also be talking about what we expect from you in terms of answering those questions. It is important that you attend this session. Obviously, the slides that we will use will be uploaded on Moodle, but you need to be there so that if you have a question, you can ask. And of course, not everything that we will say will find their way into the slide. But we will ensure that every important information given next Friday would be on Moodle. In terms of your questions, come along with any question that you might have in relation to the course and we'll be more than happy to address them as best as we can. Okay, so that will be the structure for next week. Any questions? Sorry, I didn't get that clearly. Yes, I will upload them by the end of today. Okay, it will be under Unit 4. There is another question. Is it compulsory to compare the financial ratios with industry average in our group assignment? The group assignment, if I remember well, the requirement of the group assignment was for you to calculate ratios over a 2-year period and assess company performance as a result of that, isn't it? Now, what I will also add is that it is often a good idea because remember, this is analysis. Okay, it's not just about, okay, we calculated these ratios for year 1 and year 2. These are the differences, and that's it. But if you can extend your analysis to industry average, then that's great. Obviously, you have a word limit. So you want to make sure that analyzing the ratios over the 2-year period is the priority. But you can obviously make mention of industry average. And you could actually, in my view, have important analysis when you try to relate those ratios to the industry average. So it may not be explicitly a requirement, and I wouldn't encourage you to spend too many words comparing your particular company ratios to the industry average, but you could make mention of those, and that could be important contribution. Okay.
Hello, Professor.
Mm-hmm.
I actually have a question regarding the corporate governance section that we are required to do for the assignment.
Yes.
So I believe that we are supposed to see how effective it is in the company. So are we comparing it on grounds with the academic research that's been done? Because I mean, it's really hard to, like, for us students to say how effective it is until and unless we compare it to the ratios or to past research done on it. So is like, are we expected to compare it to past research and our ratios, or is there another way to go about with it?
It's your analysis of the effectiveness. So yes, you could compare to prior research, but I'll give you an example. Okay, the corporate governance regime. So if your choosing company is UK based, for example, the corporate governance regime in the UK says there shouldn't be one person making decisions within the organization. So when you look at the corporate governance report, which most companies, if not all companies listed on the UK Stock Exchange, on the London Stock Exchange will provide, you will then see within the corporate governance report whether or not the company is run by one chairman and that one chairman makes decisions across the board. If that's the case, then the corporate governance is not effective based on at least what the corporate governance regime in the UK stipulates. But if you find that there are a range of decision makers within the organization, and the corporate governance report in many cases for many companies will be really greatly detailed. Okay, so you have a look at that. That's just one example. Distribution of role in terms of ensuring that one person does not dominate the organization. But you can make those judgments in relation to specific criteria within, for example, the UK Corporate Governance Code. And you can also make those judgments in relation to prior research.
Okay, so it's up to us based on the corporate governance report that we see in our companies that we've selected.
Yes. Yeah.
You have, I mean, just asking, do you have any idea approximately how many words it should be? I mean, because like from what when we are doing our reports, you're finding our financials to take up the majority because there's so many ratios, and
Mhm.
it's just a struggle because 2,000 words, and we have so much to put. So how do we decide what do we put that's important, and and what isn't? Because I mean, everything is important, but it's just a matter of selecting what to put on the report and what not to put. So because right now we're already at 2,000 words and we just have the last two sections to work on. So it's just trying to understand like how big is it expected to be or how detailed is it expected to be.
Okay, it's expected to be complete, but not compared in terms of the word length to your analysis. Because remember, your analysis is the key thing here. Okay, so your ratio analysis, I mean. But I would suspect that because you're looking at corporate governance as well as corporate social responsibility, right?
Yes.
Yeah,
Yes.
those are the two sections. So I suspect for your analysis, and this also includes your introduction as well as conclusion.
Yeah.
Okay. So, and how many words in total are we looking at? Is it 2,500? Was it?
2,000 maximum 2,000 words.
2,000 maximum. So my inclination would be introduction, main body of ratio analysis, plus conclusion, 1,500.
Okay.
Corporate governance and corporate social responsibility, an extra 500. That would be my inclination. However, this is not a rule. As you can see in the coursework, we have not indicated the word count that you need to consider because it's actually up to your group to determine how you are going to prepare your coursework. So it's up to you to say, well, corporate governance will probably need 300 words. Fantastic. Or 200. It's up to you. But you can see that corporate governance reports in, especially a multinational company, is quite huge and varied. And so it's just a way of summarizing what your group thinks or the extent to which your group believes that the report is effective and useful.
Thank you so much. That's helped a lot. Like it was just confusing as to how to put it together, but that's helped. Thank you.
No problem. Okay. Any other questions? Okay, let me just reiterate that it's really absolutely important that you come along next week. I'll be expecting all 62 of you next week. And Trang will hopefully be here with me as well so that we both can have that discussion. But we'll be talking about the structure of the exam, what is expected, the timing of the exam, so that you are absolutely clear when to start your exam and when to upload all of the material so that you don't get caught out. There will be plenty of time for you to do so because we recognize that probably the exam might be taken in different locations, countries around the world. Okay. Any other questions? Okay. As I said, this is our final Q&A session. If you have questions or during the week, if any questions come up, I'll be expecting that you will come along and ask those questions next week. In the meantime, if you have any further questions in relation to any of the topics that I have taught or Trang did for the first 5-6 weeks, I think, then do send us an email and we are more than happy to respond. Okay, do not assume that because the semester has come to an end, we are not reachable. No, we are. We want to make sure that we provide as much support as we can up until your final exam. Okay. Okay, there doesn't seem to be any more questions in that case. Thank you so much for coming. I hope you've enjoyed the course so far. You may not have done accounting before, but I hope that you have actually developed some knowledge and skill in relation to financial reporting and financial interpretation. Obviously, financial statement analysis is part of your finance training as well. Okay, we'll call it a day then. Okay, thanks everyone for coming along.